the stock market. For some, it's the ultimate wealth-building machine. For others, it's a terrifying roller coaster of chaos and risk. But here's the truth. Most of what people think they know about investing in the market is dead wrong. From TikTok hot takes to advice passed down at family dinners, stock market myths have shaped how millions of people think about money, and most of those beliefs are costing them wealth. Today, we're busting the top 10 mind-blowing myths about the stock market. Whether it's the myth that only rich people invest or the belief that you need to time the market perfectly, these misconceptions hold people back from building financial freedom. By the end of this video, you'll see the stock market in a completely different light, and maybe even realize you've believed some of these myths yourself. And hey, welcome back to Top 10 Facts Club. If you love breaking down myths, facts, and fascinating truths the world never tells you, make sure to hit that like button, subscribe, and tap the bell so you never miss a deep dive into money, history, and power. Now, let's jump in. Myth number 10. The stock market always goes up. They say the market always goes up, but history tells a scarier, more complicated story. Yes, the stock market has trended upward for more than a century, but that doesn't mean it's a straight line or a guarantee. Japan's stock market peaked in 1989 and took decades to recover. Even in the US, investors have faced stretches of 10 to 15 years where returns were flat or negative. Believing it always rises creates overconfidence that can leave people dangerously unprepared. The truth is, the market rewards patience, but only if you're diversified, disciplined, and willing to ride through long, painful downturns along the way. Growth is real, but it's never promised. The market doesn't always go up. What rises can stall or sink. The real myth is thinking growth is guaranteed. Myth number 9. Investing is only for the wealthy elite. For centuries, Wall Street felt like a velvet rope club. Only the wealthy could get in. But that myth is finally broken. Decades ago, investing really was exclusive. Brokers demanded huge commissions, minimums were high, and ordinary families were locked out of wealth-building opportunities. Today, the landscape has flipped. Fractional shares, no-fee brokerages, and investing apps let anyone start with just a few dollars, even the cost of a coffee. You don't need a trust fund, you need consistency and time. The wealthy may invest more, but they didn't all start that way. Many built fortunes step by step, letting compound growth transform small beginnings into massive portfolios. Waiting until you're rich to invest is backwards. Investing is what makes you rich. Investing isn't a privilege for the elite anymore, it's the ladder that lets ordinary people climb to wealth. Myth number 8, you need to time the market to win. This is one of the biggest lies that scares people into inaction. Timing the market, buying at the perfect bottom, and selling at the perfect top sounds ideal, but it's nearly impossible to do consistently, even for professionals. Studies show that missing just the 10 best days in the market over 20 years can slash your returns in half. The truth? Time in the market beats timing the market. Long-term investors who stay consistent, reinvest dividends, and hold through ups and downs almost always come out ahead. Even during market crashes, history shows recovery happens, and those who stayed invested saw major gains. Warren Buffett's advice sums it up. The stock market is designed to transfer money from the active to the patient. The myth of perfect timing keeps people paralyzed, when the real secret is simply staying in the game. Myth number 7, the stock market is only for experts. They say only Wall Street insiders can win, but the market's biggest secret is how simple success really is. But the truth is, simple strategies often outperform complex ones. Most everyday investors don't need to analyze balance sheets or chase individual stocks. Index funds, for example, let you invest in the entire market with one purchase, spreading your risk across hundreds of companies. Studies show that index funds beat the majority of professional money managers over the long term. Thanks to ETFs and robo-advisors, beginners can automate investing with minimal effort. You don't need to be an expert, you just need a plan. The real danger isn't lack of expertise, it's letting fear or overconfidence drive your decisions. The truth? The market isn't reserved for experts. It rewards the disciplined, not the complicated. Myth number 6, the stock market always crashes. Every time the market dips, headlines scream, "This is the end." But here's the reality. Crashes happen, but recoveries happen too. Since its creation, the US stock market has survived the Great Depression, 2 world wars, the dot-com bust, the 2008 financial crisis, and the COVID-19 crash, and it still hit new all-time highs afterward. Market downturns are scary, but they're also opportunities. Those who invested during recessions and held on often saw massive gains when the market rebounded. The average bear market lasts about 10 months, while bull markets last years. Believing the market always crashes makes people sit on the sidelines, missing out on decades of growth. The truth? The market doesn't move in straight lines, but over time, the trend is undeniably upward. Myth number 5. Playing it safe is the smartest move. They say playing it safe keeps you secure, but in money, safety can be the biggest risk of all. Yes, the market moves up and down, but leaving all your savings in so-called safe places like cash or like low-yield accounts quietly guarantees loss through inflation. A dollar saved 20 years ago buys far less today, while a dollar invested could have tripled or quadrupled. True, stocks fluctuate, but diversification spreads risk, so you're not betting on a single company. Over time, the real danger isn't the ups and downs of the market, it's standing still while the cost of living climbs higher. Playing it safe feels comfortable, but it quietly eats away at your future wealth. The real danger isn't taking risk, it's mistaking safety for security while inflation steals your future. Myth number 4. Only insiders or lucky people make money in the market. Movies like The Wolf of Wall Street and media headlines create the illusion that stock market success is about insider tips, wild bets, or sheer luck. But in reality, everyday people build wealth in the market by simply being consistent. Retirement accounts like 401ks and IRAs are invested in the stock market, and millions of regular workers grow their wealth this way, not by getting lucky, but by letting time and compounding work. Insider trading is illegal, and while some people gamble on meme stocks, the vast majority of wealth in the market is built steadily. The truth is boring but powerful. Buy quality investments, hold them long-term, reinvest dividends, and stay disciplined. It's not about luck or secrets, it's about behavior. Luck fades, tips fail, but disciplined behavior compounds into fortune. Myth number 3. You need to watch financial news every day to succeed. Think you need to track every market headline to win? That myth keeps more people poor than crashes ever will. Financial media thrives on drama. Every dip is a crash, every rally is a bubble, and the noise never ends. But successful investors know that constant news watching does more harm than good. Studies show that overtrading, often triggered by scary headlines, slashes returns compared to simply holding steady. The biggest gains usually happen when investors stay invested during chaos, not when they react to it. Even Warren Buffett ignores daily headlines, buying businesses to own for decades, not days. The market rewards patience, not panic, and certainly not reacting to every news cycle. The stock market doesn't reward who watches the news the most, it rewards who stays invested the longest. Myth number 2, the dividend secret Wall Street won't tell you. Think dividends are pocket change? They're actually the stock market's hidden superpower. Dividends are one of the most powerful wealth-building tools in the stock market. Companies that pay dividends consistently reward shareholders with a portion of profits. Reinvesting those dividends buys more shares, which then generate more dividends, creating a snowball effect. Over the past century, dividends have accounted for nearly 40% of the total return of the stock market. In other words, without them, investors would have missed out on nearly half the growth. Dividend-paying companies also tend to be more stable, making them attractive during downturns. Far from being a bonus, dividends are often the backbone of long-term wealth creation. Ignore dividends, and you're leaving half your wealth on the table. Myth number 1, the stock market is rigged against small investors. This is perhaps the most dangerous myth of all. While it's true that hedge funds and institutions have more resources, small investors actually have unique advantages: lower fees, more flexibility, and the ability to invest consistently without answering to shareholders. The rise of index funds, ETFs, and no-fee brokerages has leveled the playing field more than ever. In fact, many professional fund managers underperform the simple S&P 500 index, something any investor can own with one click. The idea that the system is rigged convinces people not to try at all, leaving them stuck in low-interest accounts while inflation eats their savings. The truth? Small investors who stay disciplined, diversified, and patient often outperform the so-called smart money. The system rewards those who play the long game, not those who sit out in fear. And there you have it, the top 10 mind-blowing stock market myths officially debunked. From the belief that it's just gambling to the idea that only the rich or insiders make money, these myths scare people away from one of the most powerful wealth-building tools in history. The truth is simple. Investing isn't about luck, timing, or secrets. It's about patience, consistency, and letting your money work for you. Which myth did you used to believe? Drop your answer in the comments. We love hearing your stories. And if you found this eye-opening, don't forget to smash that like button, subscribe to Top 10 Facts Club, and tap that bell so you never miss our deep dives into money, history, and power. Until next time, invest wisely, stay curious, and take control of your financial future.